Hello, this is Kirk Lynch, Associate Professor of Accounting here at Sandales Community College. Back to work another sample homework problem for you. Today we're going to be dealing with notes payable, and we have a relatively easy problem here that would equate to one of your homework problems. It says the following transactions related to liabilities occurred over the last quarter of 2000 XX of the current year for Bellbug Enterprises, and we have October 20th, purchased office equipment from Big Office Supply for $60,000, giving a series of 3 notes for $20,000 each, due in 30-day intervals. Interest rate is 8%. Then we borrowed $5,000 from First Bank, giving a 30-day note at 12% on November 5th. November 15th, we purchased inventory from XYZ Company, costing $57,000, paying $17,000 in cash, and giving a 60-day 10% note for the balance. And then finally on December 5th, our November 5th note was due, but we just paid the interest on it, renewed it for another 15-day note with a different interest rate of 9%. And it says to record this transaction to notes payable as an in and an out. In other words, debit notes payable and credit notes payable, again, in the same transaction. Our job is to journalize the transactions, journalize the payment of the liabilities in this problem as they become due, journalize any adjusting entries that arise from these transactions on December 31st of the current year. So the first thing that probably will help you is to identify exactly when we are going to have journal entries that are going to occur, because some of these generate several journal entries. So if I take these a transaction at a time, starting here with the October 20th, so I'm just going to make some notes here. On October 20th, we're going to generate a series of journal entries, and the first one is going to be due 30 days from now when this first of 3 notes becomes due. So 30 days from October 20th will be November 19th. We'll have a transaction that arises. And then 30 days after that, on December 19th, we'll have a journal entry. Then at the end of the year, we'll have an adjusting entry. And then finally, when the last of the 3 notes is due, which will be January 18th, we're going to have a journal entry. Now this second one, this November 5th, causes us to have a journal entry originally on November 5th, and then we will have one on December 5th. The November 15th transaction is going to cause us to have a journal entry on December 31st, as an adjusting entry, and then when the note is due, which actually is January 14th. And then finally, this December 5th transaction causes us to have a journal entry on December 20th, because it's a 15-day note and 15 days from December 5th. So these are the dates we're going to have to record journal entries to deal with these 4 different notes that we're dealing with here. And in the template that I have created here, I've transferred those dates in here so that we don't miss anything, first of all, and second of all, to save a little bit of time here. So let's deal with these one at a time. And our very first one says we purchased office equipment from Big Office Supply for $60,000, and we're giving them a series of $20,000 notes due 30 days apart for 8% interest. So when we buy something, issuing a note, we are receiving an asset here, which is equipment. $60,000 is the amount. And then we are giving a note payable for $60,000, a series of 3 notes total there, as a matter of fact. Let's look at the next transaction, and the next date that comes up is this transaction right here, November 5th, where we borrowed $5,000 from First Bank on a 30-day note at 12% interest. And so we're just going to record this, which we received in this case, cash, and we're giving a note, notes payable, for $5,000. On November 19th comes our first, right here is the date we're dealing with here, of this transaction right here when we purchased the office equipment with a series of notes. The first of the 30-day notes is due the November 19th date. And so what we're dealing with here is we're getting rid of one of our notes payable, and we have to calculate some interest expense that we've incurred. And here we see the formula in order to calculate that interest expense. It's a $20,000 note, three $20,000 notes, the first one due within 30 days, 8% interest, so 20,000 times the interest rate times 30 days divided by 360. Remember from earlier lectures that we use 360 versus 365 days in a year to make our numbers come out even. And this number here is the answer, $133. If we do that math, and it's actually rounded to the nearest dollar, you'll get some fractions involved here, but we'll round them to the nearest dollar. So $133 is our interest. Our note payable was for $20,000, and then we're actually going to pay this cash credit for $20,133. Now, if we look at our schedule here, that's November 19th. The next date that comes up is December 5th, and that deals with this November 5th note that was borrowed, and it actually involves this transaction right here, and that we paid the interest on this note and then reissued a new note for 15 days at a new interest rate. And so what we're going to record here is, first of all, we're going to have get rid of our notes payable for $5,000, the original note, and then record the interest expense on that particular note, which was, if we do the calculation, $5,000. The original note was 10%, 30-day, and so the interest on that note is $50. And so then we're going to reissue a new note payable and then pay the interest on the old note in cash. And so the new note is again for $5,000. The cash that we're going to pay is $50. If we look at the next date that pops up, we've taken care of this one, and this one is December 19th, and that is where, again, the second in the series of three notes that we issued for this office equipment, or office furniture rather, becomes due. And so this is December 19th, and the first thing we're going to do is get rid of another note payable, and then we have to calculate our interest expense on that particular note. The calculation is shown here. It's a $20,000 note at 8%, and it's gone 60 days now worth of interest on the second note, and so the total interest there is $267 worth of interest. The note face amount was $20,000, and so we're going to pay it in cash, and so we're going to pay $20,267 as a total amount to pay off that particular note. Now the next date, if we look back here at our list that pops up, is this December 20th date, which is when this particular note right here that we reissued the $5,000 to the bank that we borrowed at a new interest rate becomes due. 15 days after it was issued, it becomes due. So January 20th, we're going to get rid of that note payable. We're going to calculate some interest expense that we have incurred, and here's the calculation. $5,000 was borrowed at 9% interest for 15 days, and that's $19 worth of interest. So $5,000 is the face amount, the interest is $19, and then we're going to pay it in cash, which is $5,019. All right, on December 31st, we've got two adjusting entries that we have to do. One involves the third in the series of three notes that is due, and we have to do an adjusting entry to record the interest expense in this period and a liability of interest payable that we'll pay in next year. And the same problem involves this particular note, which was due 60 days from November 15th. We're not actually going to pay that till the next accounting period, but we have incurred some expense in this accounting period, and we need to record those. So we're going to do two different journal entries, one to record an adjusting entry for the interest incurred on this note, the third of these three notes, and then the one that is incurred on this note, the $40,000 that'll be paid next year. So first let's do this third in a series of notes payable. I'm sorry, that's not the right thing. We have interest expense and we have interest payable. And here's the way we calculate it. The face amount of the note is $20,000. The interest rate is 8%. And from the time it was issued, which was right here, October 20th, until the end of the year, December 31st, is 72 days. So 20,000 times 8% times 72 days divided by 360 shows us that we have $320 worth of interest expense that's accrued on that particular note, and a liability that we will have interest payable in the future for that particular note. We do a similar calculation and journal entry for the $40,000 note on the furniture. And again, the calculation is right here. It was a $40,000 note. The interest rate was 10%. And from the time that note was issued, which was right here on November 15th, until the end of the year, we have 46 days that have passed. And so 40,000 times 10% times 46 days over 360 days gives us an interest expense of $511. Now we go close out our books. The year's over, and next year's come around, and we've got a couple of notes that come due. The first one is this November 15th note right here, which we issued for the furniture, for the inventory, $57,000 worth. We paid $17,000 in cash, issued a note for the rest, which is $40,000. And so we're now going to pay that note off. So we're going to get rid of our notes payable. We're also going to pay this interest that we calculated right here, $511, and get rid of that interest payable. We're going to record the interest expense for this accounting period, and then we're going to actually go pay cash for this thing. So our note payable was $40,000. Our interest payable that we're getting rid of is $511. And we have to calculate the interest in this year. Well, the face amount, $40,000, times our interest rate, 10%. And in this year, this accounting period, 14 days worth of interest times divided by 360 gives us $156 worth of interest expense in this year. And then if we add those all up, our total check that we're going to write is $40,667. And then finally, we have the third in the series of three notes that we issued to buy the office furniture. This one is 90 days out from the original purchase date now. We've already recorded some adjusting entries to record interest that was incurred in the last accounting period. We did that right here. And so now we've got to get rid of this final note, notes payable, $20,000. And then we've got to get rid of this interest payable that we had from this calculation right here, $320. And then we've got to calculate the interest in this accounting period, interest expense. And here I have the formula to do that. $20,000 is the face amount of the note. It's an 8% note for 18 days in this year divided by 360 is $80 worth of interest in this accounting period. And then we, of course, are going to pay it in cash, so we credit cash. $20,000 plus 320 plus 80. Our total check is $20,400. And those are the journal entries that are required for these four notes that were issued towards the end of last year. And should help you in your calculation. The tricky part is to remember when you've got partial years, you do an adjusting entry to record the interest expense and the liability to repay that interest in the future. That happened with these two notes and these two entries here. and then the following accounting period, you've got to record the note being retired, the liability being retired, record the interest expense for the new accounting period, and then pay off the note in cash. I hope this has been helpful. Look forward to seeing you in the next time for another problem.